Every time the market gets near an all-time high, I start hearing these same conversations. With the market hitting a new record, I'm worried about the next crash. It feels overvalued. Maybe we should start taking some chips off the table. Now, it's a natural reaction. The higher the market climbs, the bigger it feels like it has to fall. And in today's news climate, it always feels like there's something new to be worrying about. But here's the irony. All-time highs are one of the most misunderstood signals in investing. In reality, they're not a warning sign. They're often proof that the system is doing exactly what it's supposed to be doing. So in this video today, I want to unpack some data around all-time highs, talk about what they really mean in the current market, and show why the best investors stick to their plan, especially when things feel quote unquote too high. The first thing to understand is that market highs are actually quite common. Now, they feel rare because of the headlines. Markets hit record levels. But when you look at the data, the market spends a surprising amount of time near all-time highs. In fact, over the last 70 years, the S&P 500 has been at or within 5% of a record level, roughly 1 out of 3 trading days. Think about that. If you sold every time we hit an all-time high, you'd have spent a third of your investing career sitting on the sidelines. The reason for that is quite simple. The economy grows, corporate profits rise, innovation keeps moving forward, so the market should hit all-time highs on a somewhat regular basis. If it didn't, that would actually be a bad sign. It would mean that the system has stopped rewarding some level of progress. Now, there are typically 2 fears I see around hitting all-time highs. The first is the obvious one, the fear that a big crash might be coming. Nobody wants to be the person who spends years saving, investing, and building wealth only to watch half of it evaporate in a few months. Second fear is a little more subtle. It's not that the market will crash, but that growth will simply slow down from here. After all, if the market's already high, how much higher can it really go? Both of these fears are understandable, but neither are particularly well supported by history. Let's look at the data. First, on the left-hand side of the screen, we have a chart from JP Morgan showing average forward returns from investing at an all-time high versus investing on any random day. What's interesting is that on average, investing at an all-time high actually corresponds with higher forward returns in nearly every time frame except the very short term. In other words, if you were looking purely at the data, leaving the emotion behind, an all-time high has historically been a positive signal for future market growth. Second, take a look at this chart from RBC. It shows the likelihood of the market being at least 10% lower in various time frames following an all-time high, essentially the odds of seeing a meaningful correction. On a one-year basis, there's roughly a 91% chance the market doesn't see this kind of pullback. Over 3 years, that number jumps to 98%. So statistically, the odds of a major drop right after an all-time high are very low, and the odds of continued progress are remarkably high, at least on a historical basis. Now, I know what some of you are probably thinking. All of this historical data is great, but look at where we currently sit in the market. Markets appear to be way overvalued. Here's a chart that seems to make that case pretty clear. One of the most common valuation tools investors use is the PE ratio, or price to earnings ratio. In simple terms, it measures how much investors are willing to pay for each dollar of earnings. A company or market with a low PE is often seen as undervalued, while a high PE is often viewed as expensive. At least that's the basic logic. And if we look at the current US market, the PE ratio does look elevated compared to history. Right now, the S&P 500 sits around 23 times earnings, while the long-term average has been closer to 17. On the surface, this seems to suggest that investors are overpaying, and if you squint at the data, we're creeping towards levels that we saw in the early 2000s during the tech bubble. On top of this, if you compare us to other world stock markets, many show a much lower PE ratio than the US. So it's fair to ask, doesn't this mean the market really is overvalued right now? And if that's true, shouldn't we disregard all of that previous all-time high data that we just looked at? Not quite. Well, if value in the market were this simple, wouldn't being a great investor be a whole heck of a lot easier? I want to show you a number of counterpoints to muddy these waters. First, on the left-hand side of the screen, I show a chart that compares PE ratio to subsequent one-year returns. If high valuations reliably predicted bad returns, you'd see a clear downward pattern. As PE goes up, returns would go down, but you don't see that here. These dots are pretty much scattered everywhere. The line is almost flat. The R squared of 6% basically means there's almost no relationship between valuation levels and what the market does next. You also hear a lot about how currently concentrated the stock market is within a few really big companies like Apple, Nvidia, Amazon, and how risky this is. Market concentration is not a new phenomenon. Historically, the market has gone through periods of both high as well as low concentration. So is high concentration in the market bad or risky? On the right-hand side of the screen, we see a scattered graph. Again, a flat line and an R squared that basically shows no relationship between market concentration and negative future returns. But let's continue to dig deeper into these high valuations still. When people point to high valuations in the US market, they often miss why those valuations are high. The chart on the left-hand side of the screen shows price to earning ratios by sector, and as you can see, there's a huge gap between industries. In the current market, tech companies trade at around 27 times earnings, while financials are closer to 15 and energy is around 11. That difference isn't a bubble, it's the reflection of the type of businesses that dominate the US economy to date. Over on the right, you can see that the US has one of the highest concentrations of technology earnings in the world. Nearly 30% of all corporate profits come from the tech sector. And technology businesses tend to deserve higher valuation multiples. They're capital light, they scale more efficiently, and they consistently generate higher return on equity and profit margins than almost any other industry. In other words, investors are paying more for each dollar of earnings because those dollars are higher quality. They're more predictable, more profitable, and more likely to grow over time. So when we say that the US market looks expensive relative to the past, part of that difference simply reflects a structurally different market. Comparing today's valuations full of software, data, and IP to the industrial economy of the 1980s is like comparing Tesla to a typewriter factory. The math just isn't the same. Now, I also want to point out something that often gets lost in these conversations. The market isn't just rising on hyper momentum, it's rising because corporate earnings have been quite strong. The chart on the left shows US earnings growth compared to the rest of the world since the financial crisis. You can see the US pulling away. Corporate profits have grown at a much faster and more consistent pace than both developed and emerging markets. That's not an accident. US companies have been far more efficient, far more profitable, and far more resilient even through inflation spikes, rate spikes, and global slowdowns. And when you look at the right-hand side, it tells a similar story across the globe. Very few markets have matched the strength and durability of US earnings. In other words, the market's reaching new highs because the underlying companies are earning record profits. It's not a case of prices rising while fundamentals fall apart. It's a case of fundamentals pulling prices higher. So when people say the market's too high, remember prices are up because profits are up. There are real reasons the market is where it's at today. Now, I say all of this not to make the case the market is way undervalued, just to make the case it isn't obviously overvalued as many will make it seem. And more importantly, I want to separate investment from emotions. A lot of fear around all-time highs comes from headlines, gut reactions, and half-truths that sound logical, but don't hold up to the data. Hopefully this helped you see that new highs are not a warning sign, they're a normal, even healthy part of long-term investing. That being said, it may make sense for you to take a little bit of risk off the table right now. I just want to make sure we're doing it for the right reasons. The reason, not the action, is what matters. For example, as markets rise, the portion of your portfolio in stocks naturally rises too. If your plan calls for trimming stocks and rebalancing to stay aligned with your long-term targets, that's completely rational. Or maybe your retirement plan includes a glide path that slowly moves you more conservative as you age. That's not market timing, that's following your plan. But if the reason is that the market feels too high, or I'm just going to wait until things calm down, that's emotion pretending to be logic. Because here's the truth. Things will never feel calm in real time. There's always a reason to wait. The investors who win in retirement aren't the ones who avoid volatility. They're the ones who can build a system to learn how to live through it. So if you want help creating a plan that removes the guesswork and helps you stay confident through both new highs and inevitable pullbacks, click the link below to talk with our team. You don't need to outguess the market. You just need a better plan. Thanks for watching, and I look forward to seeing you in the next video.